Seller's discretionary earnings is a cash flow-based measure of business earnings in an owner-operated business. It comprises the profit before tax and interest of a business before the owner's benefits, non-cash expenses, extraordinary one-time investments, and other non-related business incomes and expenses. This metric is used to measure the value of an organization in order to provide potential buyers with a better picture of their expected return on investment. From the seller's side, calculating the seller's discretionary earnings allows them to maximize the value of the business before getting into a business sale negotiation with potential buyers. Understanding how to calculate the seller's discretionary earnings allows the seller to make the right decision when choosing what expenses and incomes to include. When preparing a business for sale, there are various incomes and expenses that may or may not have an effect on the company's valuation. Knowing what to include in the valuation can help both parties in the negotiation process reach a reasonable valuation of the business. Here are some of the items that are included when calculating the seller's discretionary earnings. Pre-tax and pre-interest profits before non-cash expenses. This is the EBITDA, earnings before interest, taxes, depreciation, and amortization, which shows how much the company is earning. It gives the investor an overview of the return on investment that they will get once they acquire the business. One-time expenses. One-time purchases include expenses that are non-recurring and are only paid once. The expenses may include payments for website design services, purchase of a business license, one-time application fees, legal fees, etc. Non-related business expenses or income. This comprises incomes and expenses that are not related to the business core operations. Typical non-related incomes and expenses include costs incurred on a business trip for a personal vacation, consulting income not related to the business activities, fuel and automobile expenses for a business that does not require automobiles, and office rent recorded as business expenses. Adjusted expenses. When selling a business, one must account for some of the expenses that are complementary to that business. For example, when a company is selling its branded t-shirts website, the new owner will need to factor in the expenses for warehouse rent and order fulfillment since they are crucial to the success of the business. Such expenses must be included when preparing the earnings statement for the business. Areas of disagreements between buyers and sellers. When calculating the seller's discretionary earnings, there is a likelihood that the seller and the buyer will disagree on some of the incomes, expenses, and replacement costs that should be included in the calculations. The common areas of disagreements include one-time expenses. Some of the expenses included under one-time expenses may be disputed by the potential buyer on the basis of whether they are one-time expenses or they will recur in the future. For example, license fees that are included as one-time expenses may need to be paid again in the future. The same applies to web design fees since the new buyer will need to redesign the website after a few years to update it to the latest technologies. The buyer and the seller will need to agree on the appropriate items to be recorded as one-time expenses.